Hello, my friend. This is David Jaffe. We're making a review of his YouTube channel, BestStockStrategy. It's a wonderful channel. I have learned a lot from him. David essentially says that his strategy is to develop a watch list, a small watch list. If you have a small account, one or two stocks, um, and you have to watch it for a few months and see what the trading range are. You have to get comfortable with it, and then you sell puts when stock prices of your watch list are towards the low end of the range. Now, 95% of the time, the options will expire worthless because you would sell options, sell put options when the price of the underlying stock on your watch list is in the low end of the range, and you're not going to sell it at the money. You're going to sell it a little bit out of the money, so 5 or 10% below the strike price. The strike price is going to be 5 or 10% below the market price. So 97% of the time, 95, it's going to expire worthless. He advocates sometimes to close the position. If you are right and the stock takes off, then the option premium will collapse and you could buy it back for 90% of your gain already without having a corresponding time to expiration, so you can redeploy the funds in another position. So you're making 90% of your profit in 1 or 2 weeks when you have a 6-week option. That makes sense, right? In the unfortunate case that the 3 or 5% probability that the position goes against you, he says you roll the position, so you buy back the put that you sold, and you sell forward a longer dated one. So with the premium that you receive with the new one, you offset the cost of buying back the option you got. So given enough time, David thinks that that losing trade is going to be positive because of the time bias, the upward bias in stock prices. So this is what he does. For example, this is a trading range. You see a stock goes up and down, and you figure out what the range is. Ideally, you want to pick stocks that are growing, right? You don't want to do it on a stock that is just moving sideways. Normally, good stocks are growing, and so you're not gonna really be able to buy it at a very low. So if it's just below this range, it will be a good time to sell puts, like around this level, for example. So when you sell the put, we said that 3 things can happen. The underlying stock could actually go up, it could move sideways, or it could come down. And you make money in the 3 ways. If it doesn't come down more than the 5 or 10% below the market that you sell your strikes on. And if it does, then you still have the premium you receive to offset some of your losses, right? And if it really keeps going down, then you can roll the position forward and turn a losing trade into a winning trade. So he has some interesting metaphors. He compares selling puts to being an insurance company, and you're collecting premium for a very unlikely event to happen. So most of the time, 95% of the time, you're gonna be making money because all the contracts are gonna be expiring worthless. It's much the same as what happens with insurance companies. Insurance companies, sell you an insurance contract to protect you against something catastrophic happening to you. Like, for example, if you have a car insurance, if you have an accident and your car is totaled, then you have insurance, right? So he also compares selling puts to being a casino instead of the gambler, because the casino has better odds in their favor, and that's what we're doing when we're selling puts. we put the odds in our favor to make money. I think, David has a wonderful channel, and I wholeheartedly recommend it. He says he's fanatical about his system and that there's no way to improve it. But I have news for you. I'm putting up a video, telling you exactly how to improve on David's system, which is very good, I have to say. I wish you the best, my friend. Be well.